Welcome to Breaking News to Trading Moves. We are looking at the market right after the technology sector's most powerful rally since May.
hmm
And right now, we're seeing major U.S. futures. That's the Dow, the S&P 500, and the Nasdaq. They're all taking a bit of a pause, edging just a little bit lower.
Yeah, it looks like traders are just sort of taking a breath.
Exactly. They're trying to metabolize a really rapid rebound.
Yeah.
And this was influenced pretty heavily by changing expectations around the Federal Reserve's next move.
Right, and especially given the strong, concentrated move we saw in those mega cap tech stocks, they were really the ones leading the charge.
That moment of digestion, that pause, it's critical because it seems to reveal what the market's main story is right now, and that's capital rotation.
It is. We are definitely witnessing a clear, deliberate allocation of funds. Money is flowing, and it's flowing aggressively back into high-growth segments.
Specifically those tied to AI.
Specifically, AI infrastructure and deployment, yes. And this flow, well, it has to be sourced from other parts of the market. It's coming from segments that usually rely on, stable yield or a more traditional defensive position.
That really sets up our whole conversation
Oh.
perfectly. We need to track this movement very closely to understand where the momentum is actually going.
Mm-hmm.
The analysis we're looking at identifies specific sectors and even individual stocks that are being classified as the winners, the ones getting all this capital, and the losers.
The holdings being sold off to finance that move into the winners.
It's a very clear split in what the market prefers right now.
It is. And the movement isn't random at all. It's being driven by a consensus view on two pretty powerful macro forces.
Okay, where are they?
First, there's the expectation that the interest rate environment is about to stabilize or maybe even move lower. And second, there's this sustained, really unshakable conviction in the long-term revenue story of AI development.
So understanding how those two forces interact is really the key to seeing which way the capital flows.
That's the whole game right now.
All right, let's start with section one then. The clear beneficiaries. These are the winners, the ones fueling this rotation back into the growth trade.
Yeah.
We're looking at sectors that have been identified for potential long positions, all based on the idea that lower rate expectations are here to stay for a bit, and that the belief in massive AI investment isn't going anywhere.
The structural support for this whole group, it comes down to some, pretty basic finance theory. It's about the time value of money.
Right.
When the general expectation shifts toward lower interest rates, it directly reduces the discount rate you use to calculate the value of future earnings, the net present value.
So future money is worth more today.
Exactly. And for growth stocks, especially in tech, their value is overwhelmingly based on earnings they hope to make years down the road. So even a small drop in that discount rate can mathematically produce a pretty substantial increase in what they're worth right now.
And then you add the AI story on top of that financial mechanism.
And that's when you create an almost irresistible magnet for investor capital. You have this powerful financial tailwind meeting an extraordinary operational catalyst in AI, which promises, potentially exponential growth.
And the undisputed leader benefiting from all of this is the group we call mega cap AI and cloud platform.
Yep, the giants.
These are the companies that really spearheaded that whole Nasdaq surge, and they basically represent the infrastructure layer of the modern economy.
I'd call them the economic gatekeepers. We're talking about companies that aren't just users of AI. They are the fundamental providers of the cloud, the compute, the platform infrastructure that's necessary for this whole AI revolution to even happen.
Without them, the whole ecosystem just grinds to a halt.
It stalls, yeah.
So let's start with Microsoft, ticker MSFT. The analysis we have puts them right at the absolute center of enterprise AI and cloud computing.
Microsoft's position, especially through its Azure platform, is uniquely critical. You could argue Azure is the leader in catering to large enterprise customers, the ones with complex, regulated, or mission-critical workloads.
And they've integrated their Copilot tools so deeply.
Exactly. Copilot acts as an AI assistant across their whole productivity suite. So Microsoft has effectively baked AI adoption right into the daily workflow of major global businesses. When we talk about enterprise AI adoption, businesses don't need to rebuild their entire tech stack.
They just need to turn on the AI features within the Microsoft ecosystem they already use every day.
That's it. That pre-existing stickiness is incredibly valuable.
Okay, on that note then, is the adoption of Copilot translating into immediate measurable revenue? Because a lot of these big companies are pretty sensitive to per-seat pricing.
That's a crucial point, and it's one that helps justify the stock's valuation. Copilot isn't cheap, The pricing is usually structured as a pretty expensive add-on. Often it's $30 per user per month.
And that's on top of their existing subscriptions.
On top of the already premium Microsoft 365 E3 or E5 subscriptions. So this gives them an immediate high-margin revenue tailwind that analysts can model with relatively high confidence. It's just a classic upselling motion, but at a massive scale.
So analysts are tracking what percentage of the user base adopts it.
Exactly. They track the adoption rate, and even a moderate rate translates into billions in new predictable recurring revenue. And that validates MSFT's status as a core winner in this rotation.
Okay, next up we have Alphabet, ticker GOOGL. They're making their own aggressive push. Their strategy seems a little different, though, maybe more focused on the consumer-facing side of AI and competitive cloud growth.
Alphabet's strategy is comprehensive, but you're right, it's maybe a little more diffused across their whole ecosystem. They are aggressively pushing sophisticated AI models like Gemini across basically all their operating segments.
You see their core search engine.
Right. In search, AI is used to provide more complex answers and summaries. In Google Cloud, or GCP, they're competing fiercely by offering advanced AI tools and custom chips to attract startups and big customers.
So their investment is spread pretty wide.
It is. It links AI development directly to how they make money from search, from cloud services, and from productivity suites like Workspace. Their ability to manage and monetize consumer data using AI is second to none, which makes them a central way to play the broad global AI development cycle.
And then rounding out these infrastructure giants, we've got Meta Platforms, ticker META. We often just think of them as social media.
Yeah, that's the common view.
But their AI investment is truly massive, though it's maybe tied more directly to advertising than to core cloud compute.
And that distinction is important. While Meta does spend a huge amount on data center capacity, its real leverage in this rotation is tied to digital advertising revenue.
And the mechanism that drives user engagement.
Exactly. Their sophisticated algorithms rely heavily on proprietary AI to match content to users, to target ads with pinpoint accuracy, and to optimize the user experience across Facebook, Instagram, and WhatsApp.
So when investors are feeling good and taking on more risk,
that translates into higher spending on digital advertising globally. And Meta converts its internal AI power, which includes its work on open source large language models like Llama, directly into higher ad effectiveness and higher revenue per user.
So the rotation benefits META because if the economy is seen as healthy and growth stocks are in favor, ad money flows freely.
And Meta's AI tools ensure they capture a disproportionate share of that flow.
Okay, so if the mega caps are the platform providers and the software layer, the next natural beneficiary has to be the hardware that makes it all run. AI and data center semiconductors.
Yeah.
This is where the theory meets reality.
This is the most direct correlation, and you could argue it's the most inelastic demand curve in this entire rotation trade. The logic is simple, but it's powerful.
Every new AI workload needs more hardware.
Every single one. Whether you're training a massive model with trillions of parameters or just running a quick little query, it requires specialized, high-performance compute power and memory.
So if AI spending goes up,
the demand for specialized hardware has to go up proportionally, or maybe even faster, because the models keep getting more complex. This direct link means these chip makers are consistently expected to outperform the broader tech sector when the market is focused on the AI theme.
And still leading that charge, basically controlling the supply, is NVIDIA, ticker NVDA.
NVIDIA continues to hold a position that's, well, it's almost a monopoly in this specialized AI accelerator market. They provide the H100 and now the coming Blackwell series accelerators that power these massive hyperscale data centers.
And their performance is directly tied to the capital spending of the big cloud platforms.
Completely. It's tied to the astronomical capital expenditure cycles of Microsoft, Alphabet, and Meta. When conviction comes back to AI, capital just floods to NVDA.
Because of their CUDA software ecosystem.
That's their powerful moat. It effectively locks developers into their hardware. So you have this combination of hardware performance and software lock-in, and it makes NVDA the essential mechanism for playing the growth of AI infrastructure.
Okay, so with so much focus on NVDA, what makes advanced micro devices, ticker AMD, a compelling part of this rotation?
AMD is best positioned as a, let's call it a high beta story within the AI and data center chip space. They are challenging the leader with their own competitive lineup.
The MI300X accelerators.
That's the one. And while they're still working on gaining market share, any positive news about increased customer adoption, like a big order from a cloud provider who wants some supply diversity,
Hmm.
that can translate into a proportionally higher stock movement for AMD than for the incumbent.
So investors see it as having more upside leverage.
Exactly. If the AI market grows large enough to require two major suppliers, the rotation loves that story. Buying the competitor who's gaining traction in a booming market?
And then we have Broadcom, AVGO. I think investors often forget about the components that actually tie the data center together.
That's a great point. Broadcom is crucial because it addresses the complexity of scale. They have a lot of exposure to specialized high-speed networking components, the switches, the controllers, the custom silicon you need to connect thousands of AI accelerators efficiently inside one data center.
It's the plumbing.
It is the plumbing. And the other major element for ABGO is its growing custom silicon business, developing what are called application-specific integrated circuits, or ASICs.
And the big cloud customers want those.
Increasingly, customers like Google and Amazon want to design their own proprietary chips to optimize performance and, reduce their reliance on external suppliers like NVDA. Broadcom is a key partner in designing and producing these custom ASICs, which ensures they have an indispensable role in the current infrastructure build-out.
Okay, so we've covered the core platforms and the critical hardware. Now let's move to the third group of winners. Enterprise software and cloud beneficiaries, often just called SaaS companies.
The ones that monetize the adoption process.
Right.
This group is essential because they really represent the last mile of AI implementation. The rationale here rests on the sustained nature of cloud spending. These large software companies, they don't build the chips, but they integrate AI into their widely used business applications.
And they profit in a few ways.
Three main ways, yeah. They have stable, recurring subscription revenue. They're expanding their user bases as more companies digitize. And crucially, they are successfully upselling integrated AI tools that enhance the value of their core product.
And like we said earlier, the strength of those recurring revenue models becomes even more appealing if the Fed moves closer to rate reductions, because that mathematically boosts their valuation metrics.
Absolutely. You really have to look at their valuation mechanics. For SaaS companies, analysts often look at the enterprise value to sales ratio, the EV to S multiple, because they might not be profitable yet.
And a lower risk-free rate justifies a higher multiple.
Structurally, yes. The market is willing to pay more for every dollar of expected future revenue. So you have this stability of recurring revenue combined with the promise of high-margin AI upselling. And that makes them exceptionally attractive in a lower-rate environment, which reinforces the rotational flow.
Let's get into some specific names, starting with Salesforce, ticker CRM.
Salesforce is the steward of massive amounts of customer data and analytics for businesses all over the world. Their value proposition in this rotation is centered on leveraging that proprietary data.
How are they doing that?
They're offering AI-powered productivity enhancements. Think about automatically generating sales emails or summarizing customer support histories or predicting the next best action for a sales rep. By doing this, they capture value from the AI boom by making their core customer relationship management product stickier and demonstrably more powerful.
So that justifies the higher subscription fees.
It does. They're the AI layer applied directly to the sales and marketing function.
Okay, then we can shift gears a little to Adobe, ticker ADBE, which really dominates the creative and marketing application space.
Adobe has done a remarkable job adapting its long-standing model. Their revenue is supported by a robust and, highly successful subscription model, which gives it that appealing recurring revenue profile we just talked about.
And the key strategic move has been integrating generative AI.
That's right. The integration of generative AI features, which they brand as Firefly, into their flagship products like Photoshop and Illustrator. This lets users create content faster and more efficiently.
Which gives Adobe pricing power.
Substantial pricing power and retention strength, because customers have to subscribe to use the state-of-the-art AI tools they need for modern creative work.
And finally, let's touch on ServiceNow, ticker NOW. Their specialty is automating internal enterprise functions.
ServiceNow operates deep within the corporate back office. They specialize in automating workflows, particularly IT service management or ITSM.
And they're using AI for that.
They're leveraging AI tools to streamline complex, often messy internal enterprise processes by applying AI to automate ticketing, troubleshooting, employee requests. They make their platforms more efficient and, critically, more indispensable for large corporate users who are trying to cut operational costs and improve service delivery at the same time.
So their appeal to investors in this rotation is pure operational leverage, just enhanced by AI.
That's a perfect way to put it.
That provides a very granular view of the winner's side of this rotation. It's a very clear capital path into infrastructure, compute, and subscription monetization, all tied to the future promise of AI. So now, let's pivot to Section 2, the losers, the outflow targets, the segments that are directly funding this massive move toward growth.
This side of the trade is really defined by divestment, and it's driven by a collective change in market sentiment. Capital that is aggressively seeking high-growth tech has to be sourced from somewhere.
And that somewhere is usually holdings that are characterized by high debt, slow growth.
Or a primary reliance on predictable income rather than rapid appreciation. Yeah.
The first major group on the losing end here is defensive telecom income plays.
The rationale here is just a textbook example of risk-on behavior impacting yield instruments. When traders get excited about exponential technology growth, they move away from sectors defined by slow revenue growth, big debt loads, and a primary focus on the dividend payout.
And the largest U.S. telecom corporations are the classic examples.
Verizon and AT&T, absolutely. Their business model requires immense capital spending for network maintenance and upgrades like the whole 5G build-out, yet their revenue growth is often only in the low single digits.
Let's look specifically at Verizon, ticker VZ. It often serves as a benchmark for this kind of defensive income stock.
Verizon is indeed a classic yield stock. Its main draw for investors is stability and that reliable dividend. When the market story changes to valuing momentum and capital appreciation, VZ's low-growth, capital-intensive profile just makes it unattractive.
So its performance suffers when tech rallies.
Its poor relative performance during high-beta tech rallies reflects that investors are prioritizing faster growth over steady income. And on top of that, the company carries a substantial amount of debt, which makes its profitability a little sensitive to changes in long-term borrowing costs, even if near-term rates stabilize.
And what about AT&T, ticker T? They've been in the news for managing their own debt and structural changes.
AT&T is also characterized by its heavy debt burden, and that's a major anchor during periods of high-risk appetite elsewhere in the market. For investors in T, the focus tends to stay firmly on the sustainability of that dividend payout.
Which reflects the mature, low-growth nature of the core business.
It does. During a rapid rotation into aspirational AI stocks, investors just bypass these names completely. They're looking for companies that offer exponential, not linear, growth prospects. The capital needed to service that debt also acts as a constraint, limiting the resources T can put toward any truly transformative growth initiatives.
Okay, the second sector seeing noticeable outflows is utilities, which analysts often classify as bond proxies.
This concept is absolutely crucial to understanding the outflows. Utilities have an investment profile stable, regulated returns, and reliable dividends that makes them function as substitutes for high-quality corporate bonds.
Their returns are generally predictable and low volatility.
Exactly. So when investors get more confident in economic growth and they redirect capital toward equities offering stronger appreciation potential, like the megacaps, the incentive to hold these bond proxies just diminishes dramatically. Capital flows out of utilities because the opportunity cost of holding them becomes too high.
And this tendency for outflow is pronounced even if bond yields themselves stabilize, simply because the overall risk appetite for equities is elevated, as it is now with the AI rally.
Precisely. If the market is confident enough to send NVDA and MSFT higher, the perceived need for a safe bond-like equity holding whose upside is capped by regulated returns, it just declines sharply. The market wants leverage and growth, not regulation and stability.
The analysis points to two specific names here. NextEra Energy, ticker NEE, and Duke Energy, ticker DUK.
NextEra Energy is a good one to look at because it's widely held, and it includes a substantial exposure to renewable energy, which traditionally has a growth component to it.
You'd think that would help.
You would, but despite this green exposure, its core structure as a rate-regulated utility means it's still classified within that utility framework. It can underperform during robust general equity rallies as capital chases pure, high-beta, non-regulated opportunities.
And then Duke Energy. DUK, a more classic regulated utility.
Duke Energy is a large established entity. It's primarily involved in regulated electric and gas services. Its inherent regulated structure severely limits its immediate upside potential when you compare it to high-growth tech.
So its performance just lags when the market is gaining strength.
It typically lags significantly behind broader market performance when the major equity indices are strong and investors are focused on long-term appreciation. That makes it a predictable target for capital reallocation.
Okay, and finally, let's look at the traditional safe havens that are losing their appeal.
Yeah.
Gold miners.
This really demonstrates the clear inverse relationship between risk appetite and safety. A powerful equity market rebound, especially one led by a strong story like technology and AI, consistently reduces demand for traditional safe havens like physical gold and the stocks that mine it.
The narrative just switches from risk-off and preservation to risk-on and accumulation.
That's it exactly.
So as traders aggressively move capital back toward high-growth stocks, gold miners experience selling pressure unless some new, unforeseen market shock or a sudden spike in volatility brings back the fear that drives gold demand.
Correct. Right now, market confidence is being bolstered by the rebound in the AI narrative. That pervasive confidence is a direct headwind for anything that's seen as insurance against economic distress or geopolitical volatility. If the market believes the path forward is clear, driven by innovation and supported by potential Fed policy, then the appeal of precious metals just diminishes.
Looking at specific companies here, we have Newmont, ticker NEM.
Newmont is one of the largest gold miners operating globally. Its stock performance is tightly linked to fluctuations in the commodity price of physical gold.
So when market confidence is high,
And gold prices are steady or declining because inflation seems to be under control and growth is stable, NEM tends to struggle relative to the broader equity market. Mining operations also have inherent costs and geopolitical risks, which investors would rather avoid when there are cleaner, higher margin growth opportunities available in tech.
and Agnico Eagle Mines, ticker AEM.
Agnico Eagle Mines is another major gold producer. It suffers from the same capital flight as NEM when overall market confidence is strong. Investors just view precious metals companies as unnecessary or underperforming insurance during a perceived boom cycle.
The money pulled from AEM is essentially being redirected.
Toward buying potential equity growth in companies like NVDA or GOOGL.
This analysis really clarifies the market's current preference. We're seeing a strong capital preference for future growth in AI infrastructure. That means the mega-cap tech, the crucial semiconductors, and that SaaS layer that monetizes it all.
And that capital is being directly sourced from defensive holdings and yield-focused assets, the telecoms, the utilities, and the gold miners. It is a very clean, rational flow that prioritizes aspirational growth over stable returns.
So for you listening, the key question becomes, what are the conditions that have to hold for this powerful rotation to sustain itself and maybe even accelerate?
This really comes down to maintaining conviction in two fundamental pillars, and monitoring these is vital. First, the market has to maintain its strong belief that Federal Reserve rate cuts are indeed approaching, not just hoped for, but, on the schedule.
That expectation provides the structural support for the high valuations.
It's the essential support, yes. And second, the market must continue to believe that AI spending growth is robust enough and that it translates into monetizable revenue to justify the current valuations of these winning stocks.
So if that AI spending is robust, if the revenue shows up, and the Fed stays cooperative, the rotation holds. But what if the internal dynamics of AI itself start to raise questions for investors?
That is the ultimate risk, and it's what investors must be considering even now. The enormous capital expenditure that's required to build this AI infrastructure, the hundreds of billions being poured into data centers and NVDA chips by companies like MSFT and META, it must eventually lead to profitable revenue streams that exceed the cost of that investment.
Right.
The provocative thought for you to consider here is, what if the cost of building the AI engine ultimately consumes the majority of the profits it generates for the cloud providers, leaving the immense revenue stream flowing primarily to the hardware suppliers? If that conviction in end-user monetization falters, even slightly, this entire rotation could reverse course very quickly, sending capital back to assets that offer immediate, if slow, cash flow.
That gives you a very clear framework for monitoring this market action and the underlying convictions that are driving it.
Absolutely.
Just a reminder to all our listeners, this entire discussion is based purely on the analysis provided. This is not financial advice, nor is it a recommendation to buy or sell any of the mentioned securities. This analysis is purely the opinion of the author. We mentioned Microsoft, ticker MSFT, Alphabet, ticker GOOGL, Meta Platforms, ticker META, NVIDIA, ticker NVDA, Advanced Micro Devices, ticker AMD, Broadcom, ticker AVGO, Salesforce, ticker CRM, Adobe, ticker ADBE, ServiceNow, ticker NOW, Verizon, ticker VZ, AT&T, ticker T, Nextera Energy, ticker NEE, Uke Energy, ticker DUK, Newmont, ticker NEM, and Agnico Eagle Mines, ticker AEM.